Hello, everyone, and welcome to the January 15th, 2025 NYCERS investment meeting. Ms. Reyes, will you please call the roll?
Mayor's Office.
Brian Berge, representing Mayor Eric Adams, present.
Controller's Office.
John Dorsett, designee for Controller Brad Lander, present.
Public Advocate's Office.
So I just want to note, Elizabeth Guzman was in the room, has just stepped out. Her stuff is next to me, so I know she's here.
Thank you, John. Borough President of Manhattan.
Keisha Sutton James for Borough President, Mark Levine, present.
Borough President Brooklyn.
Karina Lozada Smith for Brooklyn Borough President, Antonio Reynoso, present.
Borough President Bronx.
Robert Maraglia for Bronx Borough President Vanessa L. Gibson.
Borough President Queens.
Alan Swisher for Queensborough President Donna.
Excuse me. Borough President Staten Island.
Dan Master for Staten Island Borough President Vito J. Fasella.
International Brotherhood of Teamsters.
Lawrence Bosley, Julie Covey, Ruben Torres for President Gregory Floyd.
Transport Workers Union.
Yeah, Mario Galvin for our Transport Workers Union, President of the local Richie Davis.
And District Council 37.
Robin Roach on behalf of Henry Garrido, Executive Director.
We have a quorum.
Thank you.
Let the record show that Keisha Sutton James, Daniel Master, Ruben Torres, and Mario Galvet are all attending per NYCERS video conference procedures.
Thank you very much, Ms. Reyes. I would also like to acknowledge colleagues from BERS who are participating in this meeting, even though BERS will not form a quorum for purposes of this meeting. Could those from BERS please identify themselves from the record, or for the record?
This is Salil Mehta. Oh, I see someone's going to speak. Well, this is Salil Mehta from BERS. I see Alice Ho, I believe, in the room, and then John Dorsa, designee for Comptroller Lander.
This is Karina Paulin, BERS.
Oh, okay. Didn't see. Thank you.
All right. Well, thank you very much, colleagues from BERS. Glad to see you. And with that, I will turn the public agenda over to Steve Meyer, who I believe is handling both items.
Great, thank you, Mr. Chair, and good morning, trustees, and Happy New Year, and a warm welcome on a cold New York day, New York January day. I'm going to be very brief this morning. I'm going to give you a quick update on what's going on in the economy here and abroad, what you're seeing in the markets, and more importantly, perhaps, is your performance in the midst of all that. One slide forward, please, Kate, or Donald, sorry. This is an eye chart. So Dan and I are trying to give you more information more succinctly. We're going to work on this because it's kind of hard to see. But starting on the upper left-hand side, you can see that real GDP growth around the world has actually been fairly reasonable. U.S., bless you, by the way. In the U.S., we have currently third quarter GDP estimates at 2.8% plus. Trend in the U.S. is between 2 and 2.25% growth, so growth is high relative to its average or its trend. In China, you can see obviously a higher growth rate at 4.6%, down a little bit from 4.7% in the second quarter, but below expectations. Expectations are for China to be growing at around 5%, at least that's their official internal expectation. So slowing a little bit there. UK is up a little bit from a very low level of 0.7% to 1%, and the expectation, unofficial expectation, is for that economy to continue to grow between 1 and 1.25% for the next couple of years, so not really robust. Japan, actually growth has come off a little bit, and Germany is technically in a recession of 2 quarters of negative GDP growth. From the U.S. perspective, again, U.S. outperformance is still somewhat significant, and I'll talk a little bit about more about American exceptionalism when we talk about returns. Below that, you can see CPI, or inflation indicators. Now, the right-hand side, you can see where the changes are. It's all green. That's not necessarily good. That actually reflects that inflation actually has ticked up a little bit. And if you watch the news, you read the financial press, they've talked about inflation being sticky and challenging and stubborn. Well, in the U.S., our CPI actually today for December was reported year over year up to 2.9% from 2.8%. So again, inflation's still a challenge here. It's a challenge for the Fed. It will likely cause the Fed to be on somewhat of a pause. The good news, however, with today's December CPI release is that core CPI actually came in slightly below expectations. It was expected to come in at 3.3%, came in at 3.2%, and as a result of that, bonds rallied. The U.S. 10-year Treasury yields were down about 10 basis points, and equity futures were up pretty significantly early on. Below that, as I said, you can see that elsewhere around the world that inflation's still an issue. It's still at 3.5%. In the UK, and the UK, as a result of that, has been less strenuous in their interest rate reductions, which I'll talk about in a moment. On the upper right-hand side of the chart, you can see we have the jobs market. The unemployment rate actually ticked down a little bit for December in its most recent print last Friday from 4.2% to 4.1%. Those are still very good levels, and employment's been somewhat robust. To the bottom of that page, you can see change in non-farm payroll. The market was expecting 165,000 jobs created in the month of December. It actually came in a whopping 256,000. A lot of those are retail jobs, probably related to holiday staffing and spending, but again, still a really significant and positive outcome. And then the very bottom that you can see, there's a lot of red on that screen. That actually reflects the depreciation, if you will, of currencies relative to the U.S. dollar. The U.S. dollar is very strong. If you looked at it from the other perspective, it'd be all green. But the dollar's been actually quite strong, kind of across the board. Japanese yen, 157, 158, 159. It was at its peak in July of last year at 160, 169. But again, a strong dollar is reflective of a couple things. Firstly, the interest rate differentials that are short and longer term investments or bonds and bills can deliver. Also the fact that we have higher U.S. growth rates relative to many economies outside the States. We have positive trade flows in terms of money flowing into our economy. A lot of that has to do with asset price appreciation and still the relative attractiveness of U.S. Financial assets. And finally, some element of geopolitical concerns and a flight to quality buying of the U.S. dollar over some of the other currencies. On the next slide, just a quick look at official interest rates on the upper left-hand side. Thank you, Don. That's great, Donald. Thank you. You can see that we've seen a reduction since last September of 2024 of 100 basis points or 1 percentage point in official rates here in the States. The UK Bank of England's actually cut just 50 basis points because, again, the stubborn inflation that they're experiencing there as well. And the ECB has pretty much cut rates in line with the US, moving down 100 basis points. The only outlier here is the Bank of Japan. They've actually raised rates from a negative 10 basis point official rate, which has been stuck there for almost a decade, to a positive 25 basis points. So it's a move of 35 basis points, but still very, very low levels of official rates in Japan. On the right-hand side, the upper right-hand side of that slide, credit spreads. Credit spreads are just a fancy way of saying what's the premium you get for investing in investment-grade corporates, those rated triple B minus or higher. And here you can see you get 80 basis points. So if you buy, let's keep it simple, a 5-year bond and U.S. Treasuries at 2%, you buy a corporate bond that's investment grade rated, this is a simple example would be 2.8% return. Similarly, for high yield, the credit spreads are still relatively tight at 280 basis points. So that's same analysis. If I buy a 5-year bond and it's yielding 2%, if it's a high yield corporate bond, it's going to be yielding 4.8%. And that's the premium you get for taking on additional credit default risk in corporate bonds. And I'd say the last portion of this slide is, if you zoom out a little bit, you can see that green. It's a little dated from November 6th. It was really reflecting where we were around the election time. The curve has shifted up and disinverted. If you remember, we had an inverted yield curve where short rates were actually higher even than the 30-year treasuries. And it's getting to be a more normal shape. It's specifically focused on 2 years to 10-year spreads, which is positive. And again, that continues to repair itself and normalize over the course of the last 2 months. On the next slide, 2 quick snapshots in terms of the markets. On the left-hand side, these are actually equity market index returns for the full year, calendar year 2024. And you can see the second line down up top, this S&P 500 index is up, well, it says 21.81%. If you include the dividends, it's closer to 25%. That's 2 consecutive years of almost 25% returns for the S&P 500. The last time that occurred, it was 1997, 98, 98, 99. So again, that's not to be expected. That's not normal. And again, the outperformance is certainly something we appreciate that's powered the return in the portfolio. But my expectation is for more muted returns in public equities, again, off of this great performance over the last couple of years. The last thing I'd note on this particular side of the slide is if you look down towards the bottom, and you can see the Nikkei, it's at number 30, sorry, I have my glasses with me, number 31. The Nikkei, that's the Nikkei index in Japan. What's interesting there is in local market terms, it returned 10.16%. I don't know if you can see that. It's actually right here. Returned 10.16%. But actually, in currency terms, when you convert the Japanese yen returns back to US dollars, because the yen is depreciated about 7% relative to the dollar, the return for us as US investors, the US dollar-based investors, is only a little over 2%. So currency matters, currency fluctuation matters. The fact that the US dollar is so strong might still be a great time to be investing outside of our borders, because if that normalizes or the interest rate differential goes away, that could be beneficial down the road. On the right-hand side of the slide, thank you, Don, it was great, making my life easy. These are sovereign yields, at 10-year sovereign yields, year to date. So again, just for this year. And you can see up top, U.S. Treasury 10-year yields have actually moved up about 20 basis points. That's on the far right-hand side. Over here, you can see it's up 20 basis points. The high was 479. And at the snapshot 2 days ago, it was 477. It's about 470 today. Those are relatively high, U.S. Treasury 10-year yields. If you think,
Can you speak to that, the concern of that number going to over 5%?
I'm concerned. I do think what we see is something fancy called the term premium that's further out. The further out you invest, the more that investors require a yield pickup, a yield differential. And I think that's part of it, Larry. I think it has to do with the level of deficits that we're expecting. We have a new administration come in. There's some pros and cons associated with every new presidency. I think the Trump administration is at least perceived to be pro-growth and pro-business, but also they're going to continue to hit significant deficit spending. And I think that concerns the investors. We're at about 100% of debt outstanding relative to the U.S. GDP, at about $27 trillion worth of debt relative to $27 trillion worth of GDP annually. And that number keeps moving up. I have some slides that I went through in the quarterly review that reflected the fact that we're expecting deficit spending for the next 10 years. So unless something dramatic happens, our credit quality will potentially continue to deteriorate. We also were downgraded by S&P and Fitch about a decade ago from AAA to AA+. Moody's put us on negative watch, on credit watch neg in November of 2023. So there's an expectation if we continue to spend at the levels we've been spending with these deficits that are 5 to 7% of our budget, we'll probably be downgraded there as well. And that reflects in terms of the longer term yields and where they've moved. So to answer your question more directly, I'm concerned. I wouldn't be surprised at all. In fact, I wrote that in my annual review that I think that 5% is probably in the cards. Unless there's some dramatic change in terms of the DOGE initiatives with the incoming administration to cut deficit spending, which is really tough to do, particularly given 70% of those expenses we have no discretion over. I'd say the other portion of this is that the interest expense associated with 4.7% longer term yields, 5% in 30 years, it keeps going up and up and up, and that's a significant expense for the government. And actually our deficit, just the expenses that we have now, actually exceeds our entire budget for defense spending annually. It's almost $900 billion with a B dollars a year. Things to watch. we've had a couple challenging years. If you think back to where we were in the pandemic in 2020, where treasuries, the Fed cut and treasuries rallied and there was a flight to quality. And at their peak, US Treasury yields were as low as 67 basis points. They're 270 basis points today. Sorry, they're 470 basis points today. There's another 4 percentage points in yield. So even though it's been painful, and you'll see that in some of the return numbers to get there, your fixed income portfolio is now generating more income. And as those base rates go up, the income levels, the coupon levels also go up for high yield. They go up for investment grade. So, you know, at levels where they'd gotten with zero official rates and very, very, very low and a flat yield curve, that wasn't an attractive environment. So we've had some backup. We've had a little bit of pain in terms of mark-to-markets, but we're in a better position. I actually think it's more positive for the portfolio component, consistent income. And I'm old enough to remember I started in this business in 1983 when I got out of college, and rates were a lot higher for a lot longer. You know, we went through the Volcker days when we had 15, 16% US Treasury yields. And what's interesting, just a historical fact, it used to be most of the public pension plans invested pretty much exclusively in US Treasuries, and with a duration around 10 years, which typically were over 8%. And that's how they came up with that 8% threshold. And then it was harder and harder to achieve as rates came down, so they mixed it up. You started investing in equities and private assets, and that's where we are today. On the next slide, just the last slide I'm going to go through, just a quick look at your performance for all these different time frames. So for the month of November to start, and that's interesting. If you look up top, the month of November alone, again, that's a little bit of the Trump bump. U.S. equities were up 6.7%, and that's 1 month. That's not annualized. That's 1 month's return. That's not to be expected. It actually happens to coincide with the average of the 5 different general consultants, including Callan, for the 5 different plans. The average annual return expected for U.S. equities is 6.7% for the next 10 years. So coming off of the heels of 25% returns 2 years back to back, the average is expected it should average down. I'd say the other interesting thing there is look at 1 year, November of 23 to November of 24, U.S. equities were up 32.9%. Now, John Mercerberg, who's your head of public, or our head of public equity, will tell you that's because of his expertise in managing the assets, and a lot of that is probably true. But again, those are unusual returns. And you could say, well, we came off of a bad base. 2022 was disruptive. The whole pandemic was disruptive. The sell-off, the recovery. Things are, I think, highly valued right now. So I don't think that continues. We'll see a lot, and we'll probably see a lot more volatility with an incoming administration, a change in policy, a new president who has proven himself to be unconventional and somewhat unpredictable, and volatility, it's just he's got a different style, but I expect to see a lot more volatility in the markets over time. I'd say the last takeaway here is if you look at 10 years, and those are your 10-year returns for the asset classes, so equities 12.5%, great result. You look down, private equities actually delivered 13.7%, infrastructure 12.1%. And what I find really interesting about infrastructure, if you look at 1 year, 3 year, 5 year, 10 year, it's steady Eddie. The performance has been great. I actually will say I do think that has a lot to do with Petra Nikolova, our DCIO for private assets, with Anash Kajela. I think that Petra is exceptional. I think this performance, if you look consistently, it's about 200 basis points over their benchmark. So a real strong performer for the portfolios that we're very proud of.
So Steve, I got a question. So the real estate portfolio, if we had, instead of being in partnerships, if we had actually owned buildings directly, a hypothetical, do you think the return would be in line, or do you think that, I know it's a different skill set than currently exists in BAM, and it's a much different portfolio, but I guess my question is that like a proxy for what you think real estate investing, meaning owning the hard assets, would, how would that match up? Because I know we've been doing things a certain way for decades now. And I guess the question is, as we get into, as the portfolios become more sophisticated, and we talked about this at other boards, like, do we start thinking about asset classes differently? And is the next step, is the next step like owning a building, and does that generate what you think would be stronger returns? Maybe it's a John Gluzak question next time he's in.
Yeah.
But I'm just kind of curious if we're thinking about it from 20 years ago, and it made sense 20 years ago, but as we look out 10 years, the program will have evolved to a point where we're in a different, if you think we could be at a different place. I don't know the right answer.
Yeah, I definitely think it merits further analysis, John. I do think that we could probably distinguish and differentiate our return stream. I think what you're seeing, if you look at 1 year real estate being down 3.6%, that has to do with a number of things, right? It depends on your allocation to office, which has been strained a little bit. Interest rates are much higher. The interest expense associated with any level of leverage in those funds has been painful as rates have moved up. If you own multifamily, industrial, logistics, and warehouses, I think you would have fared better. Data centers are actually really doing quite well. They reside primarily in your infrastructure portfolios, but you have some exposure in real estate, a little bit of residual exposure in private equity as well. So that's a nuanced question.
Yeah, it's
John.
a nuanced question. I mean, I'm just trying to think about it in the long term. Like we do a lot of programs evolve over time, particularly the way that we do investments. And I'm just curious if that's the next evolution is how we look at the real estate space. And that's not to take anything from what's been done, in the past. I mean, nobody's going to sneeze at a 7% return over 10 years, 7+% return over 10 years. I'm just curious if we're getting to that next horizon and doing the next iteration of that. Of the way we invest.
Yeah, those fair points.
I was going to say, if you had internal management, most likely you would have a diversified portfolio that would invest in all the areas that Steve just mentioned. But you would save on fees.
Yeah.
And so that might be the only difference, but then you paid for it other ways.
Yeah, you paid for it other ways. Yeah.
Yeah.
No, it's a good point. I'm just always thinking about how to, what the portfolios will be in the future and how they'll evolve.
Yeah.
Skating to the puck, as Wayne Gretzky would say.
John, you also mentioned the 7.4% return no one will sneeze at, which I think is a great observation. I mean, it's also 7.4% with a diversified portfolio, a higher likelihood of hitting that 7% target more consistently over time with less volatility. So again, it's not just how do you get to 7.4% with level of risk. And I do think the risks have been careful and well thought out. I have to say I'm really very proud of the folks we have within BAM. I think we work really constructively and positively with the general consultants, the specialty consultants, and with some of the new enhancements in terms of an increased analytical tool set for both public and private assets, I think will be even better over time.
And that's net of fees.
Yes, it's all net. Yeah, net returns. Yeah. With that, I'll turn it over. I know we've got a couple preliminary for executive, but
if you have nothing further,
unless there's questions.
If there's nothing further in public, I will make a motion to exit public and enter into executive.
Second.
All right, the motion has been made and seconded. All in favor, please say aye.
Aye.
Any opposed? Any abstentions? Hearing none, the motion carries.
If we could turn off the camera, please.
All right, welcome back, everyone, to public session of this investment meeting. Certain actions were taken during executive session, which Ms. Reyes will now characterize for the benefit of the public.
The board took action on 1 private equity and 2 annual plans and a NYCERS personnel matter, details of which will be shared at a later date.
Thank you very much. That concludes this meeting. Is there a motion?
Motion to adjourn.
Oh, there is. All right, all in favor, please say aye.
Is there a second?
Aye.
Yeah. I thought Karina was the second. Well, I know it's tough.